Good afternoon, everyone. My name is Julie Miller at Trenum Law. I am the assistant to D. Michael O'Leary, the phone CLE czar. Alan S. Gassman, Christopher Denicolo, and Kenneth J. Crotty will be presenting today. Alan S. Gassman is a board-certified estate planning and trust lawyer who practices in Clearwater, Florida. He has an LLM in taxation from the University of Florida and practices in the areas of trust and estate planning, business and medical practice representation, taxation, wealth preservation, and has represented well over 1,000 physicians for the last 28 years. Mr. Denicolo is a partner at Gassman, Crotty, and Denicolo, where he practices in the areas of estate tax and trust planning, taxation, physician representation, corporate and business law, probate and trust administration, and asset protection. Mr. Denicolo is the author of several noted articles in the Florida and Lamberg Information, Bar Journal, BNA Tax and Accounting, BNA Estates, Gifts and Trust Journal, Estate Planning Magazine, and Lamberg Information Services, Inc. And Mr. Crotty is a partner at the Clearwater, Florida law firm of Gassman, Crotty, and Denicolo, where he practices in the areas of estate tax and trust planning, taxation, physician representation, and corporate and business law. He is board certified in tax law. Mr. Crotty has co-authored several handbooks that have been published in B&A Tax and Accounting, Estate Planning Magazine, and Steve Lamberg's Estate Planning and Asset Protection Planning newsletters. I'm very glad to hear them speak today, and with that, I think you can take the lead.
Thank you very much, Julie. Can you hear me?
You sound very low.
Okay, is this better?
No.
How about that? Is that better?
That's better.
Okay.
Thank you.
Well, thank you very much, everybody. We're having thunderstorms here in Clearwater, Florida, so we're actually doing this on my cell phone. It's my first cell phone webinar or my first cell phone podcast, so I hope you enjoy it. Well, I've been practicing law now for 32 years or 37 years if you count my time slips, and we have never been in this type of situation where the unpredictability of the tax law, along with a robust economy following an incredible recession, are all happening all at once. And certainly many of our clients are very optimistic about the future, but also somewhat concerned about the future. And many of our clients are very hopeful that tax law is going to change soon so that their income tax rates will go down, their estate tax may be eliminated, their gift tax impediments may change. So they're really looking to us for answers. And when clients look to you for answers and all you have is questions, it's not a very impressive communication. So what we have to tell clients is that we are closely watching the situation and that we are hoping that things will come around to help them significantly, but that we do need to plan based upon the status quo. And a lot of what's happening this year is we are doing estate planning for clients, and we are having to go light on the estate tax planning because the client, or maybe one or more of the advisors of the client, have the impression that the estate tax is going to go away or is going to be significantly reduced. And we're going to do a disservice to those clients if we are not at least preparing them and letting them know that they need to come back if the estate tax law doesn't go away. And I think we all know what the big picture on that is. The big picture on that is that you can't pass a new tax law in this country unless it is revenue neutral with whatever else it goes with, and it's going to take 60 senators under what they call the Byrd Amendment or the Balanced Budget Act in order to pass a law that is not balanced. Well, there's no way that they're going to get 60 senators to pass anything that's going to make a big tax difference for the wealthy unless it also makes big tax differences for the middle class. And there's no way to get all that done and balance the budget at the same time. So any estate tax and any significant income tax relief that we see, we believe is going to be based upon a 10-year bringback. And clients who are skeptical about the government and skeptical about their ability to avoid estate tax are going to be more understanding when we explain to them that even though the estate tax may go away for 2 or 3 years, like it did in 2011, it's probably coming right back. So how are we going to plan for that? And that's the reason and the purpose for today's talk. Quite candidly, we gave this talk 2 or 3 months ago for the Florida Bar, and we don't have much different to say today. Maybe the jokes will be a little bit different. Maybe this will be a little bit shorter of a presentation. We watched a presentation by Bob Keebler recently that was presented by the Limeberg system, and what he primarily did was review how corporate tax planning works in a lot of detail, given that he expects that the corporate tax rates are going to go down and that we're all going to have to roll up our sleeves and reevaluate where clients stand from a corporate tax standpoint. And I would commend his webinar if you want a good review of the corporate tax rates. But in our situation, just beginning on our PowerPoint, and if you don't have the PowerPoint, we'll be glad to send it to you. I'm at Gassman, Gassman, at gassmanpa.com. And as an introduction, and as you know, there's 4 primary taxes here that we work with. There's the individual federal income tax, which we are at a 39.6% bracket at $418,400 in income for a single person, $470,700 for married filing jointly. Then we have the 3.8% Medicare tax, also called the 1411 tax, which was supposed to go away when they eliminated Obamacare, and of course that hasn't happened, and it doesn't look likely to me that that's going to happen. I think our clients may have a lower Medicare tax than 3.8%, maybe higher thresholds, but right now $200,000 is the threshold if you're single, $250,000 if you're married. It's a good reason not to get married. And then you have the FICA taxes, 6.2% for the employer, 6.2% for the employee, plus the employer pays a 1.45% Medicare tax, the employee pays a 1.45% Medicare tax, and then an additional 0.9% tax on wages over $200,000 for single people, $250,000 for married, on payroll taxes. And then, of course, the federal estate tax on everything over $5,490,000 per person. So we're really not able to predict what's going to change from those basic tax situations. One thing we do have is that the situation will allow for a lower S corporation tax if President Trump gets his way. We could be looking at income tax on S corporation distributions, not compensation from an S corporation, but distributions from an S corporation as low as 25 or even maybe 20%. So as a result of that, when clients ask us to set up new business entities, and of course they all want LLCs, are you going to have that LLC be disregarded and treated as a Schedule C on their Form 1040 income tax return, possibly being at the higher individual rates, or are you going to encourage them to make an S election where they will avoid the employment taxes to the extent of legitimate dividends and possibly have the advantage of the lower rates, because more wealthy clients are going to have S corporations than Schedule C businesses, and you can expect that this tax reform will probably help the wealthy somewhat more than it's going to help the middle class. Now, when will these tax reform bills become effective? In our history of our country, some tax reform becomes effective January 1st of the year it's passed. Some tax reform doesn't become effective until January 1st of the following year. Under some tax reform, you would have a blended rate. So the answer there is we don't even have tea leaves to look at because the Tea Party is about gone. So all we can do is try to educate clients and try to do intelligent planning. I think it would be a mistake to tell clients to set up a C corporation right now for anything new. One thing, please remember, you can set up at the LLC and you have 90 days from setting it up to deciding whether to make it a C corporation, a disregarded entity, a partnership, or an S corporation. And it's going to be probably important to go ahead and wait and explain to clients, normally we would make that S election right away, but because we're not sure exactly what's going to happen on Capitol Hill, why don't we wait the 90 days? And as you also know, we do have a revenue procedure which says that you have well past 90 days to file a late S election or a late entity classification, but that only applies if you can show original intent. So don't tell your client, look, you really have a year, because all we'll do is when we decide what we want you to do, we'll backdate using the revenue procedure, and we'll tell the IRS that we always intended that it be what you decide you want to be, because that is something called tax fraud, and tax lawyers usually don't do that well in jail, and you don't want to go there. So we had a client recently who wrote in under the RevProc and said, well, I actually changed my mind. And he sent in under the RevProc and said, I didn't want to be an S corporation at first, but I decided I did want to eventually, and therefore please make me an S election. And we got the acceptance of that, and now I'm wondering what would ever happen if they audited that. So do be careful on your entity classification filings. Okay, back to the PowerPoint, page 6, individual reform. What are we looking at? We're looking at the possibility of reducing 7 brackets to 3 brackets for individuals, with the highest bracket being 35%, which isn't that far from 39.6%. We're looking at a possible doubling of the standard deduction, which is going to reduce the need for smaller taxpayers to go to certified public accountants. More people will be able to use H&R Block. We're looking at protecting home ownership and charitable gift tax deductions, but losing a lot of other deductions. And we're looking at promised tax relief for families with child-independent care expenses. We're also looking at the possibility of the repeal of the alternative minimum tax. And let me tell you, we could have a lot of fun mischief in our system as tax lawyers and advisors if the alternative minimum tax is gone, because that is the backstop for a lot of things that would otherwise happen. On the other hand, the alternative minimum tax, as you know, can be a very unpleasant surprise for taxpayers. So it will be interesting to see what happens there. Now, on repeal of the death tax, we know so little about the repeal of the death tax and what that would entail. We assume that that means that there would be no federal estate tax, but there's really no mention anywhere of eliminating the gift tax. And we know that if you don't eliminate the gift tax, that the senior family members can give assets to the junior family members who are in lower brackets and then extort them to get those assets back when they want them back, and it won't be a gift either way. But I can tell you that if they eliminate the federal gift tax, we will be on the phone immediately with all of our wealthy clients, strongly encouraging them to set up creditor protection trusts in jurisdictions that do not allow creditors of the grantor to get into a trust that the grantor is the beneficiary of. We will have them gift significant portions of their wealth to these trusts where the client knows that if their net worth ever suffers terribly, they'll be able to benefit from the trust, yet the trust should be out of their estate for federal estate tax purposes. So if you are a tax lawyer or a tax advisor and you are not yet feeling comfortable using offshore or state law asset protection trusts, I suggest that you start to get comfortable and study these carefully, because your clients are going to want them. When you go to a client who has a $10 or $20 million net worth, who's age 70, and says, I've got great advice for you, give everything but $5 million away, they're going to look at you like you're crazy. They're going to have to go see their psychologist if they have one. But if you explain to them that they can gift this to an irrevocable trust that creditors can't touch, but their best friends will be the trust protectors and can restore them to being beneficiaries if their personal net worth ever drops significantly. And when you further explain that they can decide who the trustee will be and replace the trustee of the trust, and when you further explain that if the estate tax comes back, this will be off the estate tax grid, they may prefer this trust to anything else that you can offer them. So please start thinking about it. And there is an issue on whether a trust within the United States in an asset protection jurisdiction will provide true creditor protection for a Floridian who is the grantor and a beneficiary. We have no decisions yet under whether the full faith and credit clause or conflicts of law rules would allow a Florida court to say this is against our policy. And we know that the Uniform Voidable Transfers Act, which is being adopted in a number of states and is being considered in Florida, has commentary which specifically states that the courts of the state of residency of the grantor of this type of a trust will make this decision, not the court where the trust is located. So you have to decide how are you going to avoid that result from a tax standpoint, because if creditors can get into that trust, then that trust will be considered as included in your client's estate under Section 2036 a. The solution may be the hybrid trust where your client is not a beneficiary and does not become a beneficiary unless an act of independent significance occurs, such as a substantial drop in net worth, divorce, or possibly the addition of the client to the trust. And also keep in mind that these trusts can avoid the elective share, and the elective share can be very near and dear to the heart of the descendants of your clients. So I think that's going to be something that you want to keep your eye on. The other thing to keep your eye on is that right now you may not be doing life insurance trusts because you may not think that there's going to be an estate tax issue concerning life insurance. And you may decide that you're going to rely upon portability and your client's not going to really have an estate tax issue. But as you know, if the life insurance is in your client's estate, it will reduce the portability allowance of the surviving spouse. So it can make a big difference on the second death. So keep track of the clients you're doing estate plans for this year and let them know, although you're not recommending a life insurance trust right now, you may recommend life insurance when the time comes. If you're in separate revocable trusts for clients, you want to think about joint revocable trusts in the future, because your clients probably no longer have federal estate tax issues if they're a married couple under $5 million or $6 million in value, unless you think there's going to be significant growth. Are they really best suited to have separate revocable trusts, which has been the primary mode of planning in Florida for the last 40 years? Or are they better off having a joint trust, which may provide them with creditor protection as a tenancy by the entirety's vehicle if you want straight right of survivorship, or may provide them with a step up in income tax basis on the first death if you want to use the joint exempt step up trust, also known as the jest, and of course I'm not jesting, or some other type of hybrid situation that seems to them to be less complicated and less confusing than having separate revocable trusts. That's just something else to think about. Page 17 of the PowerPoint, I just have a little bit of methodology for you to go through, and you can share this with your client. Should you do anything if you are estate taxable and you're of normal health? We had a big meeting yesterday with a client who's probably going to sell his business in the next couple of years for several tens of millions of dollars. He's motivated to do some estate tax planning, even though he knows there may not be an estate tax. And we had a meeting Monday with a client who has a short life expectancy, so the same thing applies. But the other clients who don't let us do estate tax planning right now are making a big mistake. They're taking the risk of exposing their family's assets to a tax that they're hoping will go away, but which may not go away. So what we want you to think about is pictured on page 19, and that's the REAP trust. And the REAP trust is the subject of an article that we wrote for the Lineberg system recently, and it's a reversible asset protection trust. So your client may have a beautiful dynasty trust and the ability to transfer assets to that dynasty trust each year using annual exclusions or business opportunities, but they're not doing it because they don't want to put assets away if the estate tax may go away. So what they can do is set up this reversible asset protection trust. They go to one of the asset protection trust states. For example, you could use the Peak Trust Company, P-E-A-K Trust Company in Nevada, which has very low rates and is used to be the Alaska Trust Company. You can call Brandon Centula there. Brandon has a lot of knowledge in this area and amazing forms. And you can set up a trust which is an asset protection trust and which can return to your client if the estate tax goes away permanently, or can fold into your dynasty trust if the estate tax does not go away permanently. It's not a lot of work to do that, and then you have your creditor protection purpose. Let's talk about creditor protection purposes. If you're going to make a creditor protection move for a client who has a creditor risk, and let's face it, clients often don't come to us until there is a significant risk, you need a business reason to make that move. And right now, a lot of clients have that business reason. And the business reason is because they want to make some transfers now that can be reversible if the estate tax goes away. So that's another great business reason. When a client comes to you with a potential creditor situation, the reversible asset protection trust, also known as the REAP trust, is a really good thing to consider. Okay, well, I've certainly taken a lot more than 25% of the time here, but that's okay because in our law firm, I pay more than 25% of the overhead. I'm going to go ahead and hand it off now to my partner, Ken Crotty, and you're going to learn a lot from Ken, just like I always do.
Thanks very much, Alan. One thing we wanted to point out as well is if you're considering making a large gift to an asset protection trust, such as a trust in Nevada, if you make it this year, there's a good possibility that the gift tax will not be repealed for this year. So you might want to consider having your clients make incomplete gifts to the trust. Under most practitioners' belief, it used to be fine for the client to have a limited power of appointment over the trust assets to direct how they could pass, and we thought that would be sufficient to make a gift incomplete. However, after a CCA issued in 2012, to be safer, the client also needs to have the ability to veto any distributions that are made from the trust to other beneficiaries. So that's just something to consider if you are considering doing a large gift with a client. As Alan mentioned, most of the Tax Act recently that have been passed, either under 1986 under President Reagan or the President Bush's acts, were tax acts that came into effect effective after January 1st of the following year. And so then another thing to consider too with respect to planning is with the asset protection aspect of it, you also have second marriage situations. So you have plenty of situations where clients are going to want to know that the money that they saved and worked hard to save is going to be in a protective trust system for the benefit of their family and their future descendants. So one item to point out, if you look at slide 20 of our PowerPoint, is we have a brief review of the Section 2704 regulations. When these were proposed late last year, it set the estate planning community on fire because it seemed as though it was going to reduce the discounts that we take with planning associated with discounts for lack of control and lack of marketability that you would see in a normal LLC or partnership agreement. The IRS has since said that the discounts may not be reduced as much as we thought they would be originally. It's unclear. It's also unclear if the regulations are ever going to be finalized and see the light of day. But if you do have a situation with clients who might want to consider using this kind of discounted planning, You want to make sure that the entity has been formed and funded so that if the regulations ever are finalized, you'll have a 30-day window after they are finalized to actually continue and complete the planning and take advantage of the discounts that would otherwise not be applicable. And the reason it's important to have that entity funded ahead of time is that the IRS could take a position with a step transaction doctrine. If you funded the entity and then immediately or very quickly then sold the interest in the entity, the IRS could say that what you did is actually sold the underlying assets that are owned by the partnership or the LLC and try and attack the discount that way. So for many clients, we would recommend forming the LLC anyway for creditor protection purposes, having it funded, and then if they decide that they want to pull the trigger on the sale for asset or for estate planning purposes, they'll be in a position to do that, and we won't be running up against a deadline.
Now, Ken, interestingly, just wanted to chime in really quickly on the 2704 regulations. Interestingly, at the Heckerling Institute this year, a lot of commentators were of the belief that the regulations may indeed become law because the gift tax, which is the backstop to the income tax, probably will not get repealed, even if the estate tax goes away. So, it remains to be seen whether the government will put that much in resources towards this type of law, but certainly something to think about. And maybe, back in the end of last year, we were somewhat a bit hasty in saying to just go ahead and disregard the 2704 regulations. But as the political pendulum swings, we really don't know where we're going to end up. So, Ken makes some great points there about being in a position to move with agility depending on how the cards fall.
Thanks, Chris. And I think that's the basic idea behind a lot of the planning that we're doing right now is just trying to provide planning that is as flexible as possible, both from an estate tax standpoint, but also providing creditor protection and also minimizing the income taxes that are generated from the planning both now and on death. And we'll talk a little bit later about different techniques that you can utilize to help make sure that you get a step up in basis on the death of the first dying spouse and the second dying spouse, assuming that that's still something of importance. So as Alan mentioned earlier, Trump's plan for income tax reform for individuals basically would reduce the rates to 12%, 25%, and 33%. There would be a huge reduction on the amount of what could actually be taken as itemized deductions, and the possibility of the 3.8 Obamacare tax being repealed. We also have a good description for you on page 22 of the PowerPoint on the carried interest loophole, which might be of importance to certain clients, and how Trump's plan would remove that loophole. As Alan mentioned, though, one thing to consider is the Byrd rule in the Senate, which means that any tax planning that is proposed and passes has to be budget neutral. If it would result in a deficit, then it would need to have the approval of 60 of the senators in the Senate, not just the Republican majority right now. And so if you don't have that 60 senators, then you'd be in a situation where the planning would sunset after 10 years, similar to what happened with President Bush's tax cuts. So again, you're going to be probably in a good deal of uncertainty even if something does get passed. It seems unlikely that the 60 votes would be obtained, and most of the proposals that we're seeing out there are definitely not budget neutral. So, Chris, do you have anything you want to add on that?
Yeah, given what's going on today is in a big picture standpoint in the political environment, with Twitter and social media cycle, it's really hard to gauge whether any of these substantial tax cuts are going to gain steam if, as Alan said, if they don't provide benefits for the middle class because of the unpopular public opinion that can be ascribed to it. Every day it seems like there's non-tax items that are in the news that relate to this administration, whether that be climate tax or other issues that come up. So it remains to be seen if we'll even get to this point, especially given what came out at the end of April when President Trump released his tax reform plan. It didn't seem to have a lot of detail, especially on some things that us as planners really wanted to see. For example, the estate tax, it simply called for the repeal, didn't really mention much about substitute or what the income tax ramifications would be if indeed the estate tax was repealed. So who knows where we'll end up. But on the foregoing slides here, we'll be talking shortly about the blueprints that have been espoused by the Republicans and by the congressmen, so to see what the likelihood is and what the possible changes are that we might see.
Thanks, Chris. And so what we thought might be helpful too, just as a little bit of background, is I'm going to pass the microphone over here to one of our associates, Brandon, and he's going to just run us through how a tax bill becomes law.
Yeah, so just a little schoolhouse rock version here of a review of how a tax bill becomes a law. So tax bills usually start in the House of Representatives in the Ways and Means Committee. They kind of formulate a bill and put a draft together and present it to the full House, which it's then voted on. And if it's approved, it kicks over to the Senate. And that usually starts in the committee at the Senate Finance Committee, and they also review it and usually have their own tweaks and present that to the Senate as well. Once it's reviewed there, then the committees get together, they come up with a compromise version of the bill, and then it's submitted again to the House and Senate for approval. If it finally gets approved at that stage, then it goes to the president for review, and he can veto it or approve the bill. So most of the bills that we've seen right now that are out there are still in the committee, haven't really gained any ground, any traction or momentum. So we still have a long way to go here before we get anything definite proposed out there on what potentially might be changes in the tax law.
Thanks, Brandon. And I just wanted to point out two things. One, we forgot to say what the actual course code is for the bar for your CLE credits, which obviously is important for everybody involved. So the number is 1703913, N as in Nancy. And we'll give that number out again at the end of the presentation, so I apologize for not doing that in the beginning. And then one other thing I wanted to point out quickly is we gave a link to you back on page 7 of the PowerPoint. Ed Morrow has published an excellent series of articles on reviewing the various bills that have been proposed under the House and the Senate. So if you're interested in seeing the comparison of those, I encourage you to check the link on page 7 of the PowerPoint because Ed did a really great job with respect to that. So turning to the general House and Senate tax proposals, like we mentioned, most of them would really reduce the number of itemized deductions, and it's estimated that right now, under these plans, as few as 5% of the taxpayers would actually continue to itemize their planning or their tax returns. On page 28, we have kind of a recap of the Republican tax reform blueprint. Again, this would also eliminate the alternative minimum tax. It would cap the business income tax at 25%, which is higher, obviously, than President Trump's proposal. And it would also reduce the long-term capital gains tax rate to 16.5%. It would also, again, reduce a lot of the deductions and credits, and it would increase the standard deduction. And then there's also the possibility of something similar to a VAT, European-style value-added tax coming into place, which would be something interesting to take into account. And Chris, do you have anything you want to add on those?
No, looking at those particular items, it seems just in terms of likelihood, simplifying the tax code has been something preached for years and years. So, raising the standard deduction, eliminating some itemized deductions might be more likely than, say, doing a wholesale change to our system and going with the value-added tax like they have in Europe. So, again, who knows if we even get there.
Sorry to speak over you there, Chris.
No, please, go ahead.
What I'd like to do, too, is if we could move forward to slide 32 on the PowerPoint, just because we're over halfway through our time and we want to leave a little bit of time at the end for any questions that anyone might have. And, Chris, this is an item that you know a lot about, the Senate's Finance Committee and what they did to the Retirement Enhancement and Savings Act. If you could go over that for everybody, it'd be great.
Sure. So the Senate Finance Committee passed with unanimity and bipartisan support this act here, which basically serves to eliminate the concept of stretch IRAs by saying any IRA that is over $450,000, or to the extent that it's over $450,000, would have to be paid out after the death of the participant within 5 years following the end of the calendar year of his or her death. There are a few exceptions. For example, if the beneficiary of the IRA is the surviving spouse, a minor child, a disabled beneficiary, but they're very limited in scope. I haven't heard much lately as to whether this has gained traction in the House and whether it would actually become law, but this would certainly change how we plan for retirement plans. With this increased exemption now at $5 million plus inflation adjustments, we really don't have a lot of clients, or most of us don't have a lot of clients that have to face the estate tax under the present system. But more of our clients have retirement plans and have to deal with these type of income tax situations that arise. So, one of the tools we've used as planners is the Stretch IRA to enable retirement plan required minimum distributions to come out over a longer period of time, and therefore deferring the income tax associated with the distributions. So if this RESA Act comes into play here, we're really going to have to reevaluate how we plan for IRAs, whether we want to go ahead and leave them outright as opposed to in trust because maybe we want to take advantage of lower income tax rates that apply to individuals versus the compressed brackets that apply to trusts, or whether we just want to go ahead and get leave it outright and have it paid out within 5 years just to keep things simple. But certainly something to keep an eye on as we go forward into this administration and possible tax changes on the horizon.
Thanks, Chris. And slide 36, we have a couple of items too to consider from a financial standpoint for clients. It's very possible as a result of the tax changes that clients that have bought municipal bonds, thinking that that's a safe haven, that market might tank as a result of the different tax changes. A couple other things to consider too are that if you have a client who's recently converted a Roth IRA, they might want to rescind that conversion. Typically, you have until October of the year after the conversion occurs to rescind that because they might want to pay the income taxes associated with that conversion in a future year when the rates are less. So if you have the ability, turning to the next slide, for clients to defer income into the future years, it doesn't seem like that's a bad idea. It seems very likely that the rates could be lower. It seems unlikely that the rates will be higher, certainly in the near future. And then along the same lines, if you have clients with deductions that might be unavailable in future years due to tax changes, those clients should accelerate those deductions and take as many of them as they can in the current year while it's still available. And then along the same lines, if you have clients that are considering, sales of companies or sales of stock, they might want to postpone those until the next year if possible to take advantage of what might be lower tax rates on capital gains and other items. So turning to page 38, President Trump's proposal, if there is no estate tax, but there's a 100% step up on businesses and farms up to $10 million, if the step up or the basis adjustment on death is repealed with respect to other assets, that's going to be a great planning technique. We're going to be seeing people that maybe didn't have an interest in having an active business, creating a business to be under this exception, and then trying to put as much of the wealth into the business as possible to maximize that exception. Because for many clients, if we don't get that adjustment of basis at death, that's going to result in a significant higher level of capital gains that would be due when those assets are sold effectively. It's also not clear if we might go into something more like a Canadian-style death tax, where any assets that are not passing to a spouse are deemed to have been sold and subject to capital gains. That's an alternative as opposed to a traditional estate tax. But again, we don't have a lot of certainty in the area, so the best thing you can do for clients is to educate them, let them know what the alternatives are, what seems like possible alternatives going forward, and then try and put them in plans that give them the most amount of flexibility to maximize the alternatives that they have. So again, going forward, utilizing gifting, it might not be the best situation for certain clients, because if they make large gifts this year and then the basis adjustment rules don't change, if the client makes an outright gift, that gift is going to have a carryover basis. So if the estate tax goes away, and there's no estate tax liability, but you still would have had the basis adjustment. The client just generated capital gains for their donee beneficiaries that they otherwise wouldn't have to pay, especially if they're not going to be subject to any estate tax. And then again, you also need to be cognizant of the state laws with respect to estate tax, because even if the federal estate tax goes away, it's possible that some states could still have some version of an estate tax, and you don't know where your clients are going to reside in the future. So again, the planning still makes sense to go ahead and undertake that. So what we'd like to do then is if we go to slide 41, Chris, do you want to go through a couple of the techniques that we listed there?
Sure. Now, in considering what to do on the precipice of who knows what that might occur, one of the main themes here is maintaining flexibility, and that involves making transfers to trusts that perhaps provide for an independent committee that has the power to add the grantor or the grantor's family back as beneficiaries if certain independently significant events occur. Because with the unknown, we really can't take a decisive action towards a particular approach and kind of be 100% assured that we're going to cover the risk on the other side of it if what we think is going to happen doesn't come true. So this goes back to what Alan was saying with the REAP trust, or to what was mentioned earlier, like a hybrid reversible GRAT, where you could have the assets held for the grantor's benefit, with the trustee maybe having the power to make additional distributions to the grantor under the trust document, if, of course, the trust is situs in a jurisdiction that provides for creditor protection. Another way to handle this would be to do some type of gifting using formula transfer clauses, where maybe the formula is tied to the amount of gift exemption or tax that would be used, or that would be deemed to have been used at the end of a taxable year, whereby it's basically an incomplete gift when it's made, but the gift is kind of a time-lapse gift and becomes irrevocable on a certain date, only if certain circumstances exist. So that's another way to maintain flexibility. Of course, planners who have been doing traditional estate tax planning for a long time are well aware of the possibility of disclaimers, whereby you make a gift and the recipient could disclaim the gift, and you can provide in the instrument, the gifting instrument, that a contingent beneficiary to the disclaimer would be a trust for the grantor's benefit. The problem with the disclaimer is that you cannot have acceptance by the donee at any point, or else the disclaimer will not be qualified for tax purposes. Likewise, you only have 9 months from the date of the gift to make the disclaimer. So right now being June of 2017, who knows if by April of next year whether we'll have any definitive direction as to the future here. Of course, when you make gifts as well, you can do something like a Clayton Q-tip type situation where the trustee makes, or the personal representative makes, in the case of a decedent, makes a Q-tip election with respect to part of the recipient trust to have it qualify for the marital deduction, which could be beneficial from an income tax planning standpoint. But these are a number of items that have with them the characteristics of flexibility and give us the benefits of being able to take a different direction and change position quickly if circumstances change.
Thanks, Chris. And so on page 42, we put together a list of items that you could consider discussing with your clients before the year end. The first item, like we've talked about before, is putting assets into a trust in an asset protection jurisdiction. Again, one other benefit of using a jurisdiction such as Nevada or Alaska is that you are not going to be subject to the reporting requirements that you would otherwise have if you used a foreign jurisdiction. And those reporting requirements are very draconian with the penalties. And it's something that many clients are not aware of, the extent of the penalties that could be applicable. Frequently, many CPAs aren't either. And so clients, if they don't have a CPA that's really well versed in that, could be putting themselves in a situation where they're subject to significant penalties. Another thing to consider is, many of our irrevocable trusts now, we use trust protectors. Those are trusted individuals who could be appointed to change the terms of the trust, and they can change the terms of the trust to take into account differences in the tax law and or differences in the family dynamic. Beneficiary situations might change going forward, and someone that is a permissible beneficiary might want to have a different distribution standard for them going forward. So the trust protectors provide a great option for modifying a trust because the trust protectors have the ability to do that without requiring the consent of the beneficiaries. Under the Florida trust law, with an irrevocable trust, after the individual's passed away, the grantor's passed away, the trustee and the qualified beneficiaries can modify the terms of the trust. But obviously, if the modification you're seeking is going to be a detriment to a beneficiary, you're not going to get that consent. So having the trust protectors in there is an extremely important provision for many clients to have to give them flexibility going forward. One other item to consider too is there has been discussion that under the tax law changes, the concept of a grantor trust could be eliminated. We assume if it was eliminated that going forward, the existing grantor trust would be grandfathered in. Now, a grantor trust is an irrevocable trust which is treated as being owned for income tax purposes by the grantor because of certain powers that the grantor has over the trust. Typically, that would be a swap power where the grantor would have the ability to change the assets of the trust with other assets of an equal value. Now, the benefit of a grantor trust is that because it's treated as owned by the grantor for income tax purposes, if the grantor sells an interest or an asset to that trust in exchange for a note, the sale is disregarded for income tax purposes. So you're not generating any additional interest income for the grantor with respect to that. And so that could be important if the estate tax comes back with more teeth down the road. If you don't have a grantor trust in existence, the traditional planning technique of selling a discounted interest in an entity in exchange for a long-term note at the long-term AFR, that might not be available for clients if they don't have a trust set up. So just for flexibility purposes, it might make sense to formulate that. And that trust could mirror the provisions that are under their current revocable trust, so that after the death of the client, if they're single, or after the death of the surviving spouse, if they're married, then if their trusts are established for the benefit of the children or more remote descendants, those trusts could just be merged together. So you're not creating a lot more work. And also, during the client's lifetime, the reporting for these trusts are very simple. It's just a 1041 with no assets listed on it, just saying that all the income's picked up on the personal return of the grantor. So you're not generating a lot more bills for them from the CPA standpoint either. We have a couple other planning techniques that you might want to consider. And again, it focuses a lot more on deferring income, accelerating expenses, trying to take advantage of some of the planning changes that we think might happen down the road. Now, one thing to consider too is that it might be more important for clients now, it certainly is under most clients now, because the estate tax exemption is so high, $5,490,000 per person, that for married couples, what is really important for them is structuring the trust or the assets that pass to the surviving spouse in a manner so that you can get a second step up in basis on the death of the surviving spouse. And so we've got a couple of different ways to do that. And Chris, do you want to lead us through those?
Sure, Ken. The easiest way, would be the outright devise to the surviving spouse with a disclaimer into the credit shelter trust if you do not want to take advantage of having the outright devise and having the step up on the second death. Now, when we say step up on the second death, what we mean is having the assets included in the estate of each spouse, which under the current law gives a basis step up to fair market value, or a step down to fair market value, which is more unlikely in most cases. So that's what we're really trying to facilitate here. And this type of planning benefits more of our clients, given that it's an income tax issue here, not the estate tax with these extremely high limits relative to the past years. Another way to handle this is to have assets that go into a credit shelter trust instead be paid out, or have a trustee with authority to pay out such assets to the surviving spouse during his or her lifetime in order to have them owned by the surviving spouse and hopefully get a step up in basis on his or her death. Of course, this exposes the assets to creditor situations of the surviving spouse. It doesn't really provide the protection that the credit shelter trust is designed to accomplish in being established. You can still maintain that type of relationship if you do like a Clayton Q-tip arrangement that I described earlier, whereby the trustee of the trust and the personal representative can decide to make an election to have part of the credit shelter trust or all of it be considered as a Q-tip trust in order to have the assets in the trust included in the estate of the surviving spouse on his or her death. This maintains the assets in a trust structure and gives the creditor protection. The downside, of course, is you waste exemption of the first dying spouse unless you file for portability, and you might waste some GST exemption if that's an issue. We really don't know what the estate tax law will be well into the future, so you're kind of taking a risk by leaving that GST exemption on the table. The most popular approach, at least in our world, is here on slide 50, I believe, which entails having an independent committee that has the power to give the surviving spouse a general power of appointment whereby he or she can appoint assets in the trust to creditors of their estate on death. And what this does is it allows the assets to be included in the estate for federal estate tax purposes. So on the surviving spouse's death, you get a basis equal to the fair market value of the assets, which in all likelihood will probably be the step up in most cases. This approach is favored because, first, it's not automatic, so you don't really have this automatic step up or step down, which, if you don't pay attention to it, could provide detrimental or really tax-neutral results. Secondly, the assets will remain in a trust structure, will remain protected from the surviving spouse's creditors during lifetime. And third, the assets are held in a manner consistent with the wishes of the grantor, meaning that the surviving spouse doesn't have outright control over the assets and maybe doesn't have the power to disinherit the remainder beneficiaries, which would frustrate and totally abrogate the intentions of the grantor in establishing the estate plan.
That's great points you have there, Chris. A couple other items that we have before I'm going to kick it back to Julie in a few minutes to open it up so we can answer any questions that people might have are we talk on slide 54 about the possibility of having installment sales that have been maybe too good and maybe the client wants to bring back certain assets. Under the current regime, if you're concerned that a defective grantor trust, gifting trust established for the benefit of your children or descendants would not get a step up in basis on your death, you might want to consider using some swap powers to put assets into the trust that have a higher basis, such as cash or securities that have a higher basis, and getting those other assets back into your estate so that if the basis adjustment rules don't change, you can get a step up in basis on those assets as well. Just something else to consider. On slide 55, we have a brief description of a technique that we're using now frequently when we use self-canceling installment notes. Because of the Davidson case, where the IRS challenged the ability to use the standard actuarial tables to value a self-canceling installment note. Now, a self-canceling installment note is a note that cancels on the death of the grantor, and any outstanding amounts of principal and interest don't need to be repaid, and they're not considered as an asset of the grantor's estate. So it's a great way to help get people reduce their estate tax exposure. But to do that, you need to have either a principal premium or an interest premium because of the risk that the grantor might die before the note is repaid. And in the Davidson case, Mr. Davidson entered into a series of skins when he thought that he might have some severe cancer. And so even though he had opinions stating that he had a better than 50% chance of surviving a year after entering into these transactions, the IRS said, no, you shouldn't be able to use the actuarial tables to value your skin. It should be a willing buyer, willing seller standard. And so because of that uncertainty, the IRS challenged that, stating that what had happened is that Mr. Davidson, in doing these sales, made gifts equal up to the amount that the willing buyer, willing seller would have sold the note for, and the difference between that and what he actually charged on the skins. So to combat that risk, what we consider doing is forming an LLC, having the LLC owe a note back to the grantor of the skin, and then transferring the ownership of the LLC to a GRAT. And so you could reduce the value of the LLC as the reportable funding of the GRAT, have the GRAT come back to the grantor with zeroed out payments, so it wouldn't need to be reported on a gift tax return. And if the IRS ever challenged the value of the skin and said that the LLC was worth more, then what we think would happen is that under the IRS regulations, there's a clause that states that with GRATs, grant and retained annuity trusts, that if you have an issue valuing the assets that go into it and the payments later are determined that they should have been higher, that the payments just need to be made so that you don't end up making a large taxable gift as a result of the adjustment. It's just that you need to have received larger payments from the GRAT. So it's a planning technique you might want to consider. We're not sure that it works, but at least it would give you something to argue about if you hadn't on it. A couple other items. One thing to consider, too, for clients that are charitably inclined, consider having to create either a private foundation or a private operating foundation. They could make the donation to that trust or corporation before the end of the year and get the charitable deduction. And the nice thing for these clients is that they can maintain control over the private foundation or the private operating foundation. So they can distribute the funds as they see fit, or there are restrictions related to certain distributions to related parties, et cetera, and also there's minimum distributions that need to be made. But it's a nice way that the client can control the funds, similar to a donor-advised fund. But if they're charitably inclined and they want to get their children and other family members involved, it's something you might want to consider doing. So, and then lastly, at the end, we just have our cleanup time, which kind of just talks about various items that we talked about before. So with that, Julie, I'm going to send it back to you. Let me just do one thing before I do that and reiterate that our course code number for your CLE credit is 1703913, N as in Nancy. And Julie, I'll send it back to you so you can open it up to see if we have any questions.
Good afternoon, everyone. You can unmute your lines by hitting *6 to ask questions.
Okay, well, we either put everybody to sleep or we did an okay job describing everything. So, Julie, I want to really say how much we appreciate the opportunity to do this and all the help that you were in getting this set up. And Alan, Chris, Brandon, and myself, thank you for the opportunity.
Thank you. Can you repeat the code?
Sure. It's 1703913, N as in Nancy.
Thank you. Very good lecture.
Thank you, sir.